Well, greetings, everybody. I think we have a relatively intimate group here today, so that should be good for plenty of Q&A time. Everybody will get a chance to ask at least one question. And as usual, you'll be muted until I finish my little section here. Should take 20, 25 minutes. Got a number of visuals, and then we'll open it up. And it's kind of a fun one to start with here, which was taken at the New York Stock Exchange on July 11th. And it was Jim Cramer that was ringing the bell. And they always say that they don't ring a bell at the top of a bull market, but maybe they did this time. He's, as you can see from this picture, and he's sort of there in the middle, kind of leaning, laughing, and we're debating whether he's actually standing up or sitting down. Kind of hard to tell. Certainly doesn't. He's no threat to Shaquille O'Neal in that photo, but he was all smiles, and this one was taken. Whereas if we went back to April, he was semi-suicidal, and it really is kind of hard to believe how radically things have changed in such a short period of time. And I think a lot of it has to do with, what Trump did in terms of the post-liberation day, or I was jokingly calling it the obliteration day. I think it was April 8th or 9th, somewhere there in that first 10 days or so of April, where he really did a pivot because for a while it looked like he was trying to become, as a lot of people suspected and speculated, that he was trying to do a Milei. And if you don't know, Javier Milei is the president of Argentina, and he took on hyperinflation. And in a relatively short time, less than 2 years, he's been able to bring it down drastically. It does look like there is a true economic miracle underway in Argentina, but there was an awful lot of pain in the beginning to get there. But now all of a sudden, he's doing more of a Recep Erdogan, the president of Turkey, who instead of curing hyperinflation, created it. And I'm not saying that's going to happen in America, but it has been a very radical transformation. If you don't know, that's Milei, the president of Argentina. There's Erdogan, who's been a disaster, and for the economy anyway, in Turkey. But really, it's no exaggeration to say that things were almost 180 degrees opposite back in February, March, in terms of what the outlook was, which was this idea that we would take some serious short-term pain for long-term gain. And it wasn't going to be this easy money constantly falling on Wall Street that was going to be Main Street's turn. And that Yellen's policy of issuing $1 trillion, multi-trillion dollars really of T-bills in terms of new debt and rolling over old debt was a disaster, that we needed to extend maturities. She was heavily criticized for that, particularly by Scott Bessent. And so the idea was we were going to, term out the debt. They missed their chance 4 or 5 years ago when they could have done so at 0.5% or 1% or 1.5%. And terming it out at 5 isn't quite as appealing. But regardless, that was the thought. And reduce government spending. We'll talk about Doge here in a minute. Increase government accountability. Now everything is kind of inverted, completely in just a few months. So it has been. I mean, we're used to a lot of bizarre things happening in our world in recent years, but this has been really a breathtaking turn of events. And obviously the stock market has liked it. But I think we have to ask ourselves once again, how sustainable is it? And will it, even though we might see the stock market do well in terms of dollars, in fiat currency, in nominal dollars, will it do well relative to other assets which are inherently scarce? And so far this year, it's the scarce assets that have been winning, and actually for 25 years, if you count gold as kind of the ultimate scarce asset, it's been winning the race between it and the stock market, which I don't think most people on this our little podcast here do know that, because you're smart, you pay attention to things. But frankly, most people have no clue that gold has outperformed the stock market for 25 years. So with Doge, of course, tremendous amount of fanfare, but we really hardly knew you. It was such a short time that it was attempting to do anything. Of course, it was very chaotic. But the reality is, so far this year, this fiscal year, the U.S. government's on track to spend over 600 billion more than last year. Federal outlays are running higher than they did even during the peak of COVID stimulus. And the government spending has increased like 62% versus, make sure I'm not telling you wrong here because I can't see the bottom, but 63%. Since 2019, GDP is up 42%, a much more modest amount. So there's really been no change. If anything, the situation has gotten worse. The big, beautiful tax bill kind of doing the same thing, making the situation worse, not better, in terms of greater debt. And then if we look at this, and I said it looks kind of like the Charter MicroStrategy, one of the hottest stocks on the market right now. We'll take a look at that here in a bit. But this is looking at the what's happened to the amount of publicly traded debt, marketable treasury debt, so not including, say, the Social Security Trust Fund, and what's the Fed's balance sheet done. So as I think you're all aware, being the bright folks you are, that when the Fed did all those QEs, quantitative easings, it was creating digital money just off its computers and then turning around and buying government securities, putting them on their balance sheet. And for many years, they got away with it without creating inflation. But come 2020, 21, when all the stimulus checks went out and the Fed was still doing this, basically modern monetary theory where they were monetizing the federal debt. And very predictably, it led to the highest inflation since the early 1980s. So that's very prominent in voters' minds. One thing that they hate above all is inflation. And yet some of these policies that we're now moving back towards do seem to be more than just a little inflationary. So on that point, Trump clearly wants to run the economy very hot. But I think they've got to be careful because what doesn't like inflation besides voters is the bond market. And the bond markets around the world are looking very shaky, and not just in the US. So as you're aware, we like to look at multi-year breakouts, not just with stocks, but within the bond market, commodities, really kind of throughout human experience. These breakouts work, and they work really well with economic data as well. But looking at the yields in the UK, so British bond yields, these are on 30-year British government bonds. They're now well above 5%, clearly breaking out. This goes all the way back to the beginning of the century, basically. So a 25-year breakout. And as I think you're aware, in our way of looking at things, the longer a range has been in place, the more significant the breaking of that range, in this case to the upside, is. So it's a big deal. I think it's greatly underappreciated, and it's also happening in Japan. So the 30-year Japanese government bond is also making a new high for the century, the highest it's been since it's been issued. You can say, well, that's pretty close to where it was back in 2000. And it is. We'll see if it tops out. I don't think so. I think we're probably going to see this grinding somewhat higher, but it has been an amazing increase in interest rates globally, and then also in the United States. So the 30-year and the U.S. Treasury is also looking like it's at a critical level. It's not going back 25 years, but 17 years, and 5% has been the number that has held here recently. And that was the kind of the peak right before the financial crisis. And then when the financial crisis happened in 08, 09, the interest rates absolutely collapsed. And at the low, they got down, you can see here, pretty close to 1% on the 30-year Treasury. Who would be willing to buy a 30-year Treasury at a 1% yield? I don't know. But then actually in Europe, they were buying 100-year bonds with negative yields. And of course, those have been absolutely destroyed in price. And so this has been, and this is looking at the bond market from a yield standpoint. So yields have gone up drastically, which means prices have gone down drastically. So it's been a vicious bear market. And frankly, I wouldn't have bet or anticipated that the stock market could do as well as it's done since 2020, the depths of the COVID crash, as it has with such a rough period for the bond market. Now, whether this can continue, I think is a very significant question. But clearly, the Team Trump wants to see interest rates down a lot. They're talking about wanting to have short-term rates down to 1% to 2%. Of course, Jay Powell's really in the hot seat because he doesn't want to reduce rates right now. He's seeing significant inflationary potential from the new tariff regime. But nonetheless, there's a lot of pressure to cut short-term rates. The problem is, if you look at last year when the Fed lowered interest rates by a full percent, 100 basis points, the long-term rates went up. And that is a big problem for the bond market, is if you adopt these overly stimulative policies where interest rates are too low relative to inflation. And by the way, wage increases are going at about a 4%, 4.5% rate overall. We'll look at another number that's even higher, but coming up here soon. The fact of the matter is it's really hard to get interest rates down to 1% to 2% when you've got wage growth growing at about 4.5%. And the fact that so that creates what's known as a negative real interest rate situation. And the fact of the matter is that actually hurts growth. It doesn't help. It maybe gives you a little bit of a sugar high initially, but then over the long run, it is growth retarding. And we can kind of see that from this visual. So if you look at most of the last 25 years, these vertical bars that are kind of light blue indicate periods of negative real interest rates. So for most of the last 25 years, we've had that. We've had interest rates below, short-term interest rates below the inflation rate. And that 25-year period has been very poor in terms of productivity, which is what this is showing. And that's hugely important in an aging society that has a fairly static labor force. So the labor force isn't really growing. In fact, with immigration, illegal immigration being reversed and a lot of deportations occurring, and we're actually probably going to see the labor force really fall actually contract here for a bit. So that's going to take away that benefit to the economy from an increased labor force. And you're going to have to rely more and more on productivity. So that's really concerning. And just the fact of the matter, these massive federal deficits do tend to lead to lower economic growth, which is what we've seen for this century slash millennium, versus really the all those years prior to that. The only time that was kind of like this was in the stagflationary 1970s. So that's not great. I'm skeptical that what's happening here is really going to lead to enduring prosperity, but at least when it comes to bonds, there's one category that still looks highly attractive, and that's emerging market debt, which has been, frankly, kicking the butts of the developed market bond markets since the bottom of the interest rate cycle back in the summer of 2020. That's when the 10-year Treasury got down to essentially 0.5% and the 30-year around 1%. So since that tremendous bear market in bonds has occurred, emerging market bonds, they struggled for a while for sure. Pretty much all bonds went down in the first couple of years of this decade. But lately, these emerging market bonds have been performing much, much better than the so-called rich world bonds. I use this example fairly frequently with government bond yields in Brazil at 15% with a 5% inflation rate. So you're actually getting a 10% real rate of return. That's an extreme example, but many, if not most, of these emerging countries actually have solidly real rates, more so than in the United States. And the other thing that's I think pretty intriguing and attractive about them is if you look at their spreads versus the 10-year Treasury. So the spread is basically the yield differential between what the average emerging market bond pays and what the 10-year Treasury yields. And right now, it's not at an all-time high, but it's quite close. And if you took out the spike that occurred there in, I guess that would have been the invasion of Ukraine, early 2022, this is one of the highest points. And it usually, as this graphic to the text to the left shows, usually when you get to this kind of a spread, there's some kind of a crisis going on in the developing world. And yet that's not the case right now. There is no crisis. In fact, you can make the case that a lot of these emerging countries are in better shape than the U.S. is, particularly from a more disciplined fiscal and monetary policy standpoint. So that continued. Actually, speaking of breakouts, if you look at the chart of EDD, which is one of our favorite emerging market bond funds, it's broken out to a multi-year high. I think it's had a return this year of 16% or so. I think the total return with the interest included is about 20%. But it's an area that has been performing, but I think will continue to perform quite well over the balance of this decade, unlike a lot of the rich roll bonds where I think they are returning to the status of certificates of confiscation. As far as the economy, oh, sorry, I was going to say, corporate bonds are a different story. That's been an area we've done well with in the past, and I still have a soft spot for corporate bonds when they're cheap. But unfortunately, right now they're not. The spreads are very tight. That's really what this graphic is showing, is that so the upper line, the gray line, is single B rated. So these are quite risky bonds. And you can see these things have come down tremendously in their spread. So back in 2022, when I was really pounding the table on the corporate bond market, these spreads were quite elevated across the corporate bond universe, and that's changed drastically. So once again, not much in the way of attraction there. You really have to go offshore to get juicy yields. And get back to the economy. Jamie Dimon has, sorry, He's usually a pretty cautious guy, and he's still making a lot of guarded comments, but he has been picking up on the possibility of better economic growth for a while. So that's encouraging. The front page of the Wall Street Journal here 10 days ago ran this graphic that showed the recession risk coming down and stronger job growth. So it looks like the economy turned the corner. And it was like a month ago where almost all the data was looking pretty darn scary. So this has been kind of a reversal of fortune here lately. And then this is what I was talking about in terms of compensation growth. So this is looking at U.S. payrolls, and then over the last 2 months on a year-over-year basis, it's been about a 10% increase. Now, if you really zero in on this, what it's showing is a lot of the increase is coming because of state and local government spending, healthcare, kind of more more of the non-cyclical government-related parts of the economy. You're not seeing that kind of wage growth in the private sector overall. As I said, the more accurate number is around 4.5%, but still that's way, way above the Fed's inflation target of 2%. So unless you get productivity really kicking in, that's not great. Not great for keeping inflation or getting inflation down to the Fed's target, which frankly, I think they're going to just say we can't do it. So when you look at the economy, it's there definitely are positive parts of it, but it's not all glowing by any means. This is looking at the U.S. leading economic indicators, and you see a lot of charts of it for the last few years. This is kind of rare to go back as far as 1960. So this includes a lot of expansions and recessions. And what this shows you is that it's at currently leading economic indicators are at a recession type of level. They've got even lower. They've improved. It looks like they're kind of rolling over. Hard to know where that trend's going to go. But even though it didn't get as low as it did during some of the past recessions, it's been down at this level for a very long time. It's basically now like 3 years that it's been running in negative or deeply negative territory. So that's not really not that encouraging, but this is the positive here that we see that the probability of recession in the U.S. has been coming down of late. It's still at a relatively elevated level, kind of like saying the LEIs, the leading economic indicators, are still deeply negative, but it's got to say this is looking better. On the other hand, and there's it's kind of like the old Harry Truman joke. He said because he got so sick of hearing economists say on the one hand, and on the other hand, he said, "Would somebody please find me a one-handed economist?" And so I'm playing that game, unfortunately. But I think that as you go through this, you're going to see a lot of this is still flashing at least orange, and not that much in the way of green light. A little bit of that, but for example, this is the hard data versus the soft data. So basically, surveys versus actual firm reports, economic reports that come out. And for quite a while, the surveys were running so much weaker than the hard data. And in fairness, the reason why a lot of economists look at the soft data, the surveys, is because they tend to lead the hard data. And that's been the case here recently. What you can see is that for a while, the hard data was saying way stronger than the soft data, but now they're really starting to converge. Will that continue? I kind of think so, but and I think that we'll look at some reasons why coming up here in a moment. This is a pretty good reason why here. Home equity loan delinquency is up significantly, and this is looking like it's breaking out. This isn't going back that far, but if we look at credit cards, I mean, this goes way back, and this is clearly a multi-year breakout on delinquency rates on credit card loans. And it's, credit card debt is significant in this country. It's well over $1 trillion. Another big one we'll take a look at here coming up, student loans. Student loan debt in this country is something like 1.7 trillion. And there was a big moratorium, multi-year moratorium that's going away. So these loans now have to be repaid. And it's going to put a lot of pressure on a big part of the consumer class, particularly younger people. So that's, if it was on its own, you would say, well, not a big deal, but it's not on its own. We're seeing kind of a synchronization of some of these readings on delinquencies. There's commercial real estate loans, another multi-year breakout. And then this buy now, pay later, which is a relatively recent phenomenon, that it has grown explosively and people are using it to even buy groceries, which is, not a great idea to be buying groceries on on debt, which at some point that does, it's buy now, pay later, but you do have to pay. It's not that's not a freebie. Like people thought student loan was a freebie, and that's turning out not to be the case. And by the way, student loan debt can't be erased even going through bankruptcy, so it's not going to go away lightly or quickly. So then there's tariffs, which nobody seems to be worried about anymore. It was, just the top of mind, causing a selling frenzy back in March and April, and yet they're poised to hit almost 21%, which would be the highest really since 1910, higher even than during the Great Depression, the infamous Smoot-Hawley period. So it's, I mean, you look at GM's report that came out yesterday, and they announced a hit to their profits from tariffs of 1.1 billion, and their profits are down about 35% versus the prior year. So I think there's a bit of a naivete out there right now that the tariffs can be implemented without any pain. And that's certainly the way the stock market is acting. I mean, it's, as I say, Energizer Bunny is nothing on the S&P and the NASDAQ. It's now at one of the richest valuations ever. But that's been going on for a while, so it's kind of like, so what? Big deal. And if you look at this, which is looking at the forward multiple, so looking at the PE over the next 12 months based on earnings estimates, which by the way are coming down. That's one thing I've been saying for a while, is I thought the earnings estimates were too high, and they have come down to more like 3 or 4% from 9 to 10%. But even using those, the multiple on the overall, well, the 10 largest companies, so basically the Magnificent Seven plus a few more, is 28 times. Well, it's been higher. I mean, I've said several times, I don't think the real excesses are with these Magnificent Seven types of companies, or the really premier high growth, typically high multiple, but not outrageous. I mean, you look at well, Google's only about 20 times earnings, and Microsoft is, in the 30s, and that's expensive, but it's not outrageous. It's not the 100+ types of PEs that we see in so many of these hyper growth stocks that in many cases barely have any profits at all. But it is interesting, if you look at the S&P, excluding the top 10, the multiple looks much higher relative to past peaks. So I think this would be supportive of the view that where a lot of the overvaluation is occurring in the stock market is with the smaller companies. And frankly, some of these really high PE companies, they exclude them from the calculation. So the numbers would look even worse if they were really properly accounted for. But I think this is something to be, really aware of, because corporate insiders have had a good record of getting defensive before market declines. And right now, insider selling is very intense. It was very intense earlier in the year, and then we had the sell-off and things kind of calmed down. And you can actually see this where insiders swang from quite bearish to even a bit on the buy side there when the market was melting down, and now they're back into the highly bearish positioning currently. Market breadth. So you look at the stocks that are advancing versus declining, or those that are at 52-week highs, the divergence from that. It's not a good looking breadth pattern at all. And that hasn't forewarned for some of the sharp corrections that we've had in recent years. Fear and greed index we brought up in the spring when everything was getting pounded, that it was in extreme fear. Reading it, if we went back to April, this needle would have been far to the left, and now it's gone back to extreme greed. We were also pointing out there was a global margin call going on at that point, which created some great buying opportunities. People were forced, investors, millions of investors were forced to sell just to pay down their debit balances. Well, right now, margin debt is back to where it looks extremely concerning at basically record levels. And yet I see very little commentary on the threat to the market from all this debt, which is, debt is really kind of it's a four-letter word, but it's also probably the most powerful word out there right now, because that is, the U.S. economy has become so heavily financialized, and there is so much debt out there that it does create a lot of fragility in the system. And when you get these periodic shakeouts like we had in April, that debt can come in and really bite people in a hurry, where they're forced to sell things that they don't really want to sell. Now, on the positive side, let's talk about corporate profits, which are very strong and have been very strong. This has been the big differentiator versus, say, foreign markets, where basically it's the Magnificent Seven companies like Microsoft and Google and Amazon, Apple. They reported fantastic profits until recently. Some have started to struggle. Tesla was part of that group for a while. Now it's actually reporting negative earnings growth, and Apple's profits have basically flatlined. And So it does look like perhaps this extraordinary period of outperforming the rest of the world and really being way above kind of the long-term trend lines, which are those lower lines. Maybe we're starting to exhaust that very tangible example of American exceptionalism with some of our great companies. And we've got, I was just looking at this yesterday, the top 10 market cap companies in the United States come to something like $16 trillion of market cap, just 10 companies. And that's basically the market value of all the other major developed countries. It's just stunning how much some of these companies are worth. And is Nvidia, worth 4 trillion? I don't know. That seems to me a pretty big number. I know business is really strong for them right now, but will it stay that way? There's a lot of concern that perhaps AI is starting to run out of gas. But if you think the stock market's frothy, which I do, I don't think it's that, I don't think it's overvalued everywhere. I think there continue to be pockets of value, though not as many as there were obviously back a few months ago. But what's crazy, absolutely crazy, is what's going on in the crypto world. And I don't know how many of you are aware of these Bitcoin treasury companies, but they are just, proliferating wildly. And I'm absolutely convinced this is going to be the next disaster to happen because it's not like you say, well, you've got some great technology that deserves to be, trading at a monster PE multiple. These guys own Bitcoin. And the trouble is the investors are paying way over the actual underlying value of the Bitcoin just to get into these companies that borrow money or issue shares to buy more Bitcoin. And it just seems like kind of the ultimate Ponzi scheme. I just don't see how this doesn't have another very unhappy ending as so many of these speculative surges have had, even the last 5 years. And remember the meme stocks, which went straight up in 2021 and then absolutely crashed and burned. And frankly, if you remember in my book, I was warning in 2022 that I thought a lot of the crazy overpriced stocks would get clobbered, and they went down 70, 80, 90% in 2022. Now, many of them have come roaring back, but at least with those, there's in many cases some actual intrinsic value. But some of the stuff with crypto is a lot of it is just absolutely, there is no underlying source of value other than what somebody else is willing to pay for it. So you get these frenzies going, and it's really the greater fool theory on steroids. So, could it go higher? Absolutely could go higher. One of the things that's interesting about the new part of this new paradigm from the Trump administration is to be very pro crypto. I'm sure you've seen that, but I believe one of their big motivations is they want to use stable coins to help fund the federal deficit. So if they issue a lot of T-bills to these, let's say Tether, which I think owns 150 billion of treasuries right now, somewhere around that, they get like a uh, built-in group of buyers. And if there are even more stable coin issuers, well, there's going to be even more treasury buyers. And I think one of the things that they're going to try to do is the government itself will do its own stable coin. Because if you're Tether and you are holding $150 billion of treasuries that are paying you 4%, you're not paying your, they're not shareholders. They're the ones that are transacting in the stable coin. They get nothing. They get no interest. It's not like at a bank where you might get some interest. So they're making a killing. And so I'm sure the government is saying, well, we would like a chunk of that, if not all of that. So they might start issuing stable coins that don't have any yield. And so now they can finance that portion of the federal deficit for free. And that would Trump is making it very clear that this $1 trillion a year that the U.S. government's now starting to pay out in interest is unacceptable. So they're starting to get very creative about how do they get the short-term interest rates down. And I think the stable coin way could do it. And they're talking about 2.7 trillion that they'd like to see going into stable coins. When I say they, people like Scott Bessent. And if that's the case, a lot of that's going to go into Bitcoin and some of the other junky cryptos. Bitcoin is in a class by itself. It's definitely the blue chip entity in that space. So maybe that's going to create another upleg for Bitcoin. But it's getting pretty crazy out there. This MicroStrategy, which really started the trend towards these Bitcoin treasury companies where they buy Bitcoin and put it on their corporate balance sheet, and they use a combination of leverage and new issuance of stock to do it. And this MicroStrategy is up 600% since the start of 2024. And now there's like 141 of these Bitcoin treasury companies that have come out. And so, that's kind of the undercuts this whole idea that with Bitcoin, you're getting a lot of scarcity. Maybe with the absolute underlying Bitcoin you are, but with all these derivative things that are coming up, it's not the case. It's quite the opposite. So here you see the chart of what's happened to MicroStrategy, which I think now has changed its name to Strategy. I guess they figure they're not micro anymore. Maybe they call it macro strategy pretty soon. But anyway, it's had a big move for sure. But look at this one, MetaPlanet. So MetaPlanet is actually a Japanese hotel company, but then they announced that they were going to start doing Bitcoin Treasury. It went up 2,500% very quickly, and now it's starting to come down. And I wouldn't be surprised if it comes down a lot. And again, it's just going to see one after another of these things that go up with this kind of a slope and then come crashing back down. And the trouble is, so many people get in at these high points, and so when things reverse, they get really clobbered. Okay, so closing stuff here. Team Trump wants to run the economy hot. There's no question about it. The idea that there was going to be pain in the first couple of years of the administration and then things start to really revive, kind of like what Milei did in Argentina. That's not at all how it's turning out. The yield curve is likely to steepen considerably, and that is good for certain areas. And commodities typically benefit from that. Financial stocks, because financials usually borrow short and lend long, so steep yield curve is good for them. The mortgage REITs that we wrote up here this week, like Annaly and AGNC, if you look when you're in an interest rate easing cycle and when the yield curve is steepening, they actually raise their distribution significantly. And AGNC currently is paying 15%. I'd be happy if they just maintained it, but their history would indicate it could actually go up quite a bit. So to me, it looks like the market is poised for another shakeout. This just seems like there's way too much enthusiasm, way too much complacency, way too much debt, and way too much insider selling. So we'll see, but we did get a pretty good shakeout last summer. Had, of course, the Liberation Day event and the lead up to that. So even in a bull market, you do get corrections. Overseas stocks and bonds continue to outperform, and I think this is a multi-year situation, not just a fleeting one. And I think the riskiest crypto plays. I mean, Dogecoin I saw is back up to like a $40 billion valuation, and that's like the valuation of kind of a decent sized U.S. blue chip stock, and it's worth nothing. It's amazing, but these things are just they're just trading tulips or trading sardine cans, whatever way you want to say it. Long-term bonds in the rich world look challenged. I think they're still in this phase where they're going to lose money for investors, particularly on a real basis after inflation. So it's an odd time. It's one of the oddest times I've ever seen, but I've only been doing this about 46 years, so I guess I can always learn. But I think it's saying this is a new era and it's all going to be just fine and we're not going to ever have a reckoning. I think that's not really accurate. It could be true for a while. And I do know that Darius Dale, who's had a terrific track record, as some of you know, switched to bullish back in April or May, and after being very defensive, but he's starting to make some noises about getting more cautious because he just sees too much speculative fervor out there right now. And I'm certainly with him on that one. All right, let's do some questions. Thank you.
If anyone has a question, you can raise your hand with the react button down at the bottom of your screen.
Hi, Jeff.
Good morning. How are you?
I'm still
Hey,
here.
I was wondering what impact you think the tariffs are going to have on the possibility of a recession. Assuming it goes in at 21%, how much in the economy are we talking about? And could that by itself tip things over?
Yeah, it could. I mean, supposedly it's going to be a hit of about $2,800 per U.S. household. And, for the wealthier folks, no big deal. But for, more like the lower middle class or, anything below that, that starts to get pretty tough. And you probably have seen the same stuff I have, that it's something like 50% of American consumers couldn't afford even a $500 extraordinary expense. I mean, they've got so little cash on hand And I think that's why you've seen credit card debt go up so much and why you're seeing this buy now, pay later phenomena. So yes, I think that there isn't a lot of a lot of cushion in the economy. I think that so many millions of consumers are really, they're stretched just as tight as it can possibly be, and the rubber bands could snap at any moment. And for some people, I think it is snapping. In fact, if you look at bankruptcies, they're rising at the fastest rate since the Great Recession, both for individuals and corporations. So there is evidence that it's starting to bite, and I think the tariffs are only going to make it worse. And I think realistically, some of those tariffs will get passed on. Some of them will get absorbed by the overseas exporter. Some will get absorbed by, let's say, a distributor in the United States. And so the pain, I think, will be spread out, but I think there's still going to be pain. And it is effectively a fairly significant tax increase. And there are some tax decreases that are going along with it, but net, you're still looking at higher federal spending and a bigger budget deficit despite the tariff revenue. So I mean, I understand what the goal is in doing the tariffs and trying to get industry back to American shores, and that's a laudable goal. But it's again, it gets back to this idea: can we take the pain that we need to incur to be able to get the gains that we want? And Americans aren't too good about the pain part. They want the gain, but with no pain. And I think that's been played out on a very large scale in our country, where instead of, let's say, having tax hikes, we just opted to borrow more money. So we constantly resort to debt as a way to maintain things, looking like they're very prosperous when they're not so prosperous. And I would say that comes under the category of there's going to be a reckoning. It's not going to be as simple and as downside free as we'd like it to be. Certainly, that's not what the market believes currently.
Okay, thank you. Like you, I sit around wondering what the that breaks the camel's back will be.
Well, it's a great question. You could say the bond market, but then the counter argument to that would be, look, you just showed how much rates have gone up, and yet the stocks have been able to appreciate along with it. But I think at some point, and I don't know what that point is, but I'd say somewhere between 5% and 6% on the 30-year Treasury, that gets to be unavoidable. That just starts to bite. So at some point, that I think if I had to name a likely culprit, it would be that. The other thing that I think it could be underappreciated right now is because this was a big theme a few months ago, then it's died down, and this is an interesting twist on why it's died down, is the amount of money. It's like $21 trillion that's owned by international investors, and they were starting to exit because for them the currency is a big deal, and so they've actually been losing money on the U.S. stock market this year because the S&P has gone up less than the dollar's gone down. And there's a lot of pressure on these entities, these institutional investors from overseas, not to be as exposed to the U.S. market as they are. Their various their underlying clients or supervising clients, whichever way you want to look at it, are saying, hey, we want to bring our money, let's say, back to Europe from America or back to Japan from America. And partially, I mean, you saw the interest rates on Japan, the bond yields over there have gone up so much that it's now fairly attractive to buy Japanese bonds, especially in a deeply undervalued currency. But whatever the reason is, there is a shift going on, but apparently one of the big reasons that hasn't happened more decidedly than it has so far is because so many European investors go on vacation this time of year. And once the summer is over, there is a school of thought, and it kind of makes sense to me, but only time will tell if it's really that big a deal, that come September, we'll see some very dedicated selling of U.S. assets by overseas investors, and particularly those in Europe. I don't think that's as much of an issue in Asia. I'm not even sure they take vacations in Asia, but Europe, of course, is a very different story. But you're right. It's always tricky to identify what is going to be, the pin that pricks the bubble. But there are a lot of bubbles out there, and I think there's nothing more bubbly than what's going on in the crypto world. Anybody else?
Dave, can you hear me?
Yes. Hi, James.
Sorry. Yeah, I apologize. I'm driving, and so I apologize for the noise, and I didn't
Oh,
know
it's
which
Jim. Jim, hi,
it
Jim.
is. It is. And I didn't know which button to press to raise my hand, so I just thought I'd jump in. So, a
Please.
question for you. Well, first of all, I have so many questions, but I'll spare you.
That's okay. We got time.
I want to ask you about oil, but before I get to that, I'm somewhat of a fan of Bitcoin. All the others are crap. I agree with that. But I do like Bitcoin, and I bought a little more Bitcoin, a little more gold lately. And my rationale behind that is, and it's a question for you. Do you think we're getting closer to the day when maybe Luke Groman's idea, I can't see this playing out, but maybe we're getting closer to it, where we're getting back to potentially we're getting to a revaluation of gold and a gold-backed currency, and maybe not that specifically, but if you look at all the gold that central banks have been buying, and you've talked about all of that, um, and even if and I do think the stable coin is going to become something, as you talked about, where the government's going to use that to sell treasuries, but that doesn't help pay down the debt or help us with our deficits. And so are we going to get to a point where perhaps the yuan and other currencies are backed by gold? Maybe the US is backed by gold or Bitcoin. And then just general store of value. I mean, does that make sense as to why we would want to continue to maybe accumulate gold, not necessarily the miners, but physical gold? And I do want to get your thoughts on oil.
Sure. Well, I think what you're describing is what's going on. It's no longer speculation. I mean, when you have people like Scott Bessent coming out and openly talking about trying to encourage 2.7 trillion to go into stable coins, I mean, this is obviously front and center for them as part of this trying to solve what I've called the 4F scenario, the federal fiscal funding fiasco that they've got. It's because there's just, particularly with foreign buyers out of the picture, they're really not buying uh, U.S. Treasury debt on balance. I mean, you got some buying, some selling, but it's their percentage of their holdings of U.S. Treasury staying about the same, but the issuance has gone way up. So their percentage of treasuries outstanding has come down drastically in recent years, like for the last 10 years. And then you don't have the Fed buying, with Fed is still slightly selling treasury. So you've got these two massive buyers that are gone. So they have a real challenge in how do they finance deficit. That's why I think that, as I said earlier, you had Bessent before he got in the office. He was very critical of Janet Yellen for relying so heavily on T-bills. He gets in there, he's doing the same thing. But now they're having this kind of epiphany because for most of crypto's life cycle, the U.S. government's been quite hostile. So this is what's really kind of changed my mind is that they're now seeing the crypto as a way to help them fund these deficits. And you're right, it's not paying down debt. It's just creating another pool of buyers that I think they kind of stumbled onto with this whole stablecoin thing. But I don't see that it does them a whole lot of good if they're paying Tether 4% as opposed to paying the banks 4%. In fact, you probably say it's better to be paying the banks 4% because that money might get back to the economy better and multiply and so forth. But that's why I think that what they're going to do is try to figure out a way. And I know it goes against the whole DeFi thing, decentralized finance, to have the government issuing stable coins. But on the other hand, it gives you kind of a sense of security. And if you're really just using it as an on-ramp and off-ramp, trying to get to the cryptos themselves, like Bitcoin, and I really don't understand. I've brought this up a number of times. I've really never gotten a great answer why they have to use these stable coins as the intermediary, but they do. I mean, that just seems to be a fact of life. And so if they can figure out a way, they being best at the Treasury and so forth, to issue these things in a way that people feel good about them, because I don't feel safe with the Tether. I wouldn't feel safe with the Tether. They've never produced an audit. Anyway, so that would be, if they could actually issue that for free to the tune of $2.7 trillion, that would be hugely beneficial to the government. So I do think that's going to happen. The other thing they could be doing, kind of to your point, is accumulating. I mean, they obviously have a lot of gold in Fort Knox. Maybe they've been buying even more gold here. And there does seem to be an awful lot of gold flowing into the United States. Maybe there's some kind of secret program to be accumulating gold. Trump has talked about having some kind of sovereign wealth fund. Maybe they're running that or getting a head start on it. And maybe doing the same thing with Bitcoin, where they accumulate a lot of Bitcoin. So if Bitcoin goes from 100,000 to a million, that's a windfall to the treasury. They can use that to repurchase debt. So yeah, I think that they're looking at everything. I was listening to Judy Shelton yesterday, and she's a former Fed, I think she was a Fed governor, certainly a senior Fed official. She was rumored to be Fed chairman at one point, but she's talking about having bonds backed by gold, and that's something that I believe is likely to occur. Is you're going to get a two-tier bond market in the treasury world, where you've got some bonds that are simply fiat backed, where they can be inflated and lose a lot of purchasing power, which is what's happened for the last 5 years. And then another class, which are backed by hard assets, gold being the most obvious and easiest. But there's others that you could probably do that with as well. And there's quite a pattern for that in history of countries that get really in bad shape. They get into way too much debt, and then they have to collateralize their bonds with real assets. I think that's where we're going, and I think you're seeing more evidence of the most senior government officials acknowledging that. Did you want to ask about oil too?
Yeah, he did say he wanted to hear your thoughts on oil.
Well, Jim knows more about oil than I do, so I feel a little reluctant, but it's there's a lot of other commodities that have been kind of dead in the water for the last few years. I mean, kind of the peak for commodities here recently was when Russia invaded Ukraine. Certainly that was the case with oil, but a number of the other commodities have turned around, and we've fortunately ridden those pretty well here of late, but not oil. Oil continues to trade very sluggishly, and yet inventories are very low. And I think there's a tremendous amount of misinformation about the true status of the supply-demand situation. The authority is the IEA, the International Energy Administration, and they have for decades told the world that there is going to be a glut of oil. The demand is growing very feebly, and that's just turned out to be wrong. And actually, global oil demand right now is running quite robustly for an economy that's just kind of coming off the mat. And the U.S. has been kind of booming along here with these big deficits for a while, but a lot of the rest of the world has been pretty sluggish, and now it looks like we're starting to slow down. The rest of the world's starting to accelerate, and the reality is that's what matters, because, as you know, Jim, where the demand growth has happened over the last 15 years has not been the developed economies; it's been the emerging nations that have seen the huge demand increase. And China is probably getting pretty close to where they're not going to grow much going forward. But the rest of the emerging world, I think you're going to just continue to see surprises on the upside. But oil is, so many people and powerful entities want to see it lower. I mean, obviously Trump wants to see it lower, and before him, Biden wanted to see it lower. So it's like every time it goes up, something happens that pushes it back down again. And whereas with gold, if gold goes up a lot, the governments don't care. They might even like that for the reasons we talked about a moment ago, that it could actually give them the ability to, say, mark up their gold holdings at one point and use the windfall gains from that to buy back treasury bonds. But that doesn't work with oil. But eventually, I think, and you see the drilling rig count continues to go down, and the Cushing storage levels are very low. And so basically inventories around the world look tight and demand looks healthy, and yet prices are down. At some point, I think that's going to rectify itself, but I certainly wouldn't try to tell you when. Anyone else?
I'll try one more if I'm allowed.
Sure.
Corporate profits. How do I look at them considering what's gone on with interest rates? Interest rates were high, interest expense was high, it came down, they refinanced, came down, they refinanced, it got down to absurd levels, they refinanced a lot. Just that improves their bottom line income statement, and then they take all that money and they invest it if they're not using it right now. Huge cash balances earning 4% or more. What's been the impact on profits over that period of time? Is it significant that I need to make some sort of adjustment when I look at an income statement?
Well, that should be reflected on the income statement. So what you're talking about is how
Yeah,
the
true.
the cash-rich U.S. companies have really benefited from the higher interest rates. Is that what you were? Is that how you led into
Well, they
this?
benefited when the interest rates came down. Um, a lot, their interest expense declined dramatically as rates declined and they refinanced. Then they were able to finance it at 2, 3, 4% when 30-year rates were down at a little over one. And now they're earning interest on all that extra cash. Um, has that had a meaningful impact on the bottom line overall?
Well, I think it's had to. I mean, I think, like you said, it was kind of a two-step process. First, rates came down, and this is kind of on point with what I was trying to make the the distinguishing between how the government reacted to much lower interest rates and how the private sector did. So when interest rates went down to that 0.5%, 1% back in the summer of 2020 after COVID, the private sector refinanced like mad. They termed out debt, so they extended their maturity. Just think about people that refinance their mortgages, or they went from an adjustable rate to a fixed, and so that happened. There's trillions of dollars involved in that was the right thing to do. The government didn't do it, and that's where they've been heavily criticized. This idea that they kept issuing such a large portion of T-bills that as the interest rates went up, the government's, that's why, a few years ago, the government was paying 400 billion of interest. Now it's paying a trillion. It's because they didn't lock in their yields. And some people believe, and I think probably correctly, that they couldn't, that if they had tried to sell a lot of long-term bonds back then, there just weren't that many buyers and the rates would have exploded on them. And I don't know, it's kind of counterfactual. We'll never really know, but it seems like they could at least give it the old college try, and they didn't. But yeah, for the private sector, if you, it's like so many things. They talk about the K-shaped economy, right? K-shaped recovery. And that's probably going to continue to be the case, that the rich get richer and the poor get poorer, because if you've got a lot of a lot of capital and you don't have much debt, higher interest rates are a really good thing. But then if you're a weaker company that was borrowing money at 2 or 3% a few years ago, now you're paying 8, 9, or 10, you may be going out of business. So I think it's extremely dependent on this, just kind of logical to say this, that the nature of your balance sheet. So for cash-rich entities, it's been terrific. And that's why, frankly, I think that if the Bank of Japan wants to get things going in Japan and to do it in non their short-term interest rates are still only like 0.5%, get them up to 2. And because that kind of the corporations have got huge cash savings, the consumers have huge cash savings. I think it would be great for their economy and it would help to rally the yen. But uh, anyway, I think it depends on the company, depends on the consumer. But unfortunately, I think it's exacerbating this process that you described, which I think is valid, is exacerbating the wealth divide that we have in this country.
Okay, thanks. I think I'll go look at some 5-year-old financial statements and compare it to some conservative current ones and see what I see.
Yeah, well, there'd be no question for the Microsofts of the world that their interest income has gone up dramatically over the last 5 years. It had to have, and their interest expense hasn't, because they had long-term debt. They were issuing 10, 20, 30-year bonds way back when.
Yep.
Anybody else?
You want to talk about natural gas just a little?
Well, yeah, sure. It's a funny market because it's so different than oil. I mean, oil doesn't have much of a price difference, whether it's in Europe or America, a little bit. I mean, Brent trades at a premium, whereas natural gas is, multiples higher in Europe than it is even in the United States. And then in Canada, I haven't looked real recently, but I think natural gas prices in Canada are still sub $2 per thousand units BTUs. And it's that's is it? It's yeah, million BTUs, and then it's BCF. But it's yeah, it's a very I think it's an incredibly cheap commodity, but it was a year ago, back last September, was trading around 220, and now it's kind of in the mid threes. So it's not as cheap as it was, but it's still very cheap compared to the rest of the world. And a lot of the natural gas stocks have come alive, and will they keep going up? I kind of think so. I think that some of these natural gas stocks are going to be great plays. I think that with the whole AI thing, that yeah, nuclear is coming, but nuclear is going to be a while. And the natural gas, these cogeneration combined cycle plants can be a solution right now. So I think you're going to see a dramatic increase in natural gas consumption. And then you'll continue to have the demand from overseas. And the US is opening more and more LNG facilities, liquefied natural gas, so we can ship our gas overseas. And ethane, which comes out of natural gas, is in greater demand. And that can be used as a heating, well, actually to make propane to be a fuel source for areas like in Africa, and it'll be a great improvement for quality of life for the people, citizens of those countries. But yeah, I mean, I think it's a good story. I don't think it's like table pounding right now compared to where it was a year ago. A year ago, I thought it was table pounding, but still attractive.
Okay, thank you.
Well, you're welcome. It wasn't very insightful, but I'd say I'm just kind of mildly bullish on natural gas at this point, to cut to the chase.
Good morning. This is Alan. I'd be curious to hear your thoughts on the oil strategic reserve and why we haven't started refilling it, and what your thoughts are on, how that could affect oil going forward.
We've refilled it a little bit, but very little. I don't have the exact numbers, but what I last saw was, maybe Jim, who was on here a moment ago, knows, but it's minuscule. But it gets back to what I was saying earlier, is that with oil, there's just so much pressure to keep it down, political pressure. Maybe because when people drive by and they look at the price of gasoline, it's the thing that's the most visible as far as what's happening with inflation. And if gas prices are down, it gives a sense that inflation's under control, which may not be the most accurate way to do it. I don't think it is, but I do believe that that's kind of how. I mean, there's no question that the politicians view gasoline prices, not natural gas prices, as absolutely essential for their political platform. So Biden wanted them down, Trump wanted them down, and so to refill the SPR, I think is not very likely. I mean, they should be with oil prices down. They should be refilling the SPR, but so far, like I said, it's been kind of a trickle.
All right, thank you.
Sure.
Well, we're right about at time and don't think we have any other questions, so we could probably call it.
Thanks for your time, everybody.